Welcome to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Here's your host, Grant Bledsoe.
Hello, everybody. Grant Bledsoe here. Welcome back to Grow Money Business. This week on the show, we're talking about business cash. Cash is something that we've covered on the show a little bit recently, but from the angle of your personal cash you might have in a savings account and how to get the most out of your FDIC coverage. This week, we're talking about cash in your business, specifically how and when to take it out. How do you figure out how much cash should remain in your business? And if you have too much of it, how do you take it out of your business in a tax-efficient way? It all depends on your annual planning, your business strategy, forward-looking financial statements, and entity structure, and we cover all those details in today's episode. I hope you enjoy it. Hey everyone, I need to interject quickly to remind you all that nothing found in today's episode or any other episode of Grow Money Business should be considered financial, investing, legal, tax, fitness, or even relationship advice. It's content that you're free to use and to deploy on your own terms. And before taking any actions on content found on the show, please do consult with your tax professional, your attorney, or your financial planner. If you don't have a financial planner, head on over to threeoakswealth.com to learn more about what we do in terms of financial planning and investments and how we help clients on an ongoing basis. Today on the show, I'd like to talk a little bit about cash. Not just cash, where to stick it, making sure that you're getting an appropriate interest rate, which is more relevant today than it was a couple of years ago. We've covered that on the show here in the last month or two. More so, what to do with the cash in your business. How much cash do you need in your business? When is an appropriate time to take cash out of your business and pay yourself? How should you be paying yourself? How can you take cash out in a tax-sensitive manner? This is something that is relevant to a whole lot of business owners. It's a question that we get a whole lot in our financial planning practice. And to be totally frank, I thought that we had covered this to death on the podcast. Come to find out, I don't think that's the case. I was looking through some of the episode history over the last month and last few months and even the last couple of years. And I think what happened here is we talk about this so much with our clients. I talk about this a lot whenever I'm a guest on other people's podcasts that I just kind of assumed that we had covered it on Grow Money Business in a whole lot of detail in the past. And looking through the episode history, I don't think that's the case. I think this may be a topic that I've inadvertently overlooked a little bit. So that's what I want to talk about today, because the question most often comes up in the form of, I feel like we're doing well in the business. We have cash accumulating in the account. It feels like I have too much cash in the account. I know that we have inflation right now and I could be doing something better with it, but I don't want to pay tax on the distributions if I take cash out of my business. I'm not sure how much I should take. I'm not sure whether to pay myself in a profit distribution or maybe via salary. There's just a lot of questions that come up with this concept. So I wanted to go over the framework of how we like to think about this in today's episode, because it all really starts with your business's needs and what you want to do in the business and your upcoming cash expenditures and so on and so forth. So I'll give you an analogy here to start. When we talk about an emergency fund with your household cash, you've probably heard me say before, if you've listened to a fair number of our show's episodes, that everybody needs a little bit of cash liquid and available to you for a rainy day. You can call it an emergency fund. You can call it a rainy day fund. You can call it a cash reserve. You can call it whatever the heck you want. But it's really important to have a little bit of cash on the sidelines in case a bunch of bad things happen all at once. Because having that emergency fund in place is what helps you avoid selling investments at an inconvenient time or putting expenses on credit cards and things like that. We don't want to do those things. That's why we have a little bit of cash set aside. And that's really of vital importance. And if you look back to our financial order of operations that we covered here a few episodes ago, in what sequence should you set your goals, this is like priority number one. You need a little bit of cash just in a savings account available to you. Well, the manner in which we determine how much cash that should be. Should it be $5,000? Should it be $25,000? Should it be $100,000 or more? It really depends on your monthly living expenses. And generally, I like to think that people need somewhere between 6 and 12 months worth of living expenses as an emergency fund. For business owners, usually it's on the higher end of that spectrum because your income tends to be a little bit more volatile. You're taking a lot more risk by virtue of being the prime principal owner in your respective organization. So if you're spending $10,000 a month and you want 12 months worth of expenses as an emergency fund, then bang, $120,000 is what you should target for an emergency fund. Well, your business is different than your household with regard to its cash needs and so forth, but it's kind of in the same ballpark. And really, how much cash you need for your business's working capital or emergency fund, really they're synonymous in this context, depends on what your operating expenses are. And it depends on your annual planning and the stuff that you want to spend money on going forward. So to give you a simple example, if you have an organization, let's call it a sole proprietorship for the moment, and you have, let's say, $25,000 in monthly operating expenses, and your business is steady Eddie. You have consistent recurring revenue. You know precisely exactly what your revenue is going to be for the next 6 months, maybe even the next 12 months. Your operating expenses are consistent. They're not going to change. You're not planning on reinvesting more money into the business for growth. You're not planning on hiring anybody. You're not planning on letting anybody go. You know with a lot of confidence that your expenses are going to be $25,000 a month. Well, generally, businesses need somewhere between 3 and 6 months worth of cash and operating expenses as a business emergency fund. Where you fall on that spectrum, now this is my opinion, of course. Some people say you need less cash, some people say you need more cash. But in this simple scenario, where your monthly expenses are going to remain exactly consistent, you might need somewhere between 3 and 6 months. If you're in an industry where you have a lot of confidence, the industry and the economic environment is going to be fine, and you know what your revenue stream is going to be, well, you might be more comfortable having working capital that's a little bit on the shorter end of that spectrum, maybe closer to 3 months. If you're in a volatile industry, or maybe your business is a little younger and you don't have quite as much confidence that the revenue stream is going to persist in the way that it has, or you have uncertainty over your expenses, well, then maybe you want to target a little bit more than 3 months. It really depends on industry, it depends on business, it depends on the specifics of how you want to run it. The more conservative you are, the more cash you want to have on hand at all times, so that if revenues dry up, you have a stockpile there to keep the doors open, keep paying your expenses without making any changes for a little longer. The more aggressive you are, the less cash you keep in the account, the shorter your runway if things go sideways on you. So that's the framework, okay? And in this circumstance, let's say that you have $25,000 worth of operating expenses. You have a really consistent revenue stream. You're really comfortable that that's going to persist into the future indefinitely. You might want 3 months worth of cash on the sidelines. So you've got $75,000 as your cash target. What that means is, let's say that you have at the beginning of the month, you've got $45,000 in the company bank accounts. You know that $25,000 of that is going to go out the door, and if all your revenues dry up, you'll be left with only $20,000 at the beginning of month number 2. What you want to do is, with your revenues that are coming in, you pay the $25,000 in monthly expenses, and anything on top of that, you just let accumulate in the company bank account until you get to that $75,000 threshold. If you're shooting for 6 months, it's $150,000. It might take you a little longer to build up that cash reserve or that working capital, whatever you want to call it, for a business rainy day fund. usually doesn't happen overnight. So for most businesses, it takes a little bit of time to build up. You want to keep, hopefully you're not keeping every penny of your working capital in a checking account. Hopefully you have some of it in a savings account that earns a little bit better interest rate. And if you want to know more about that, check out a few episodes ago. We talked about FDIC coverage and where to get a reasonable interest rate these days that's protected by the federal government. You probably want some of that cash that you might not need to write a check on anytime soon in a higher interest bearing account. That could be a savings, it could be a money market account. There are a lot of different options. It could be a short-term CD, theoretically. There are a lot of different options. So let's take the other side of this. You have consistent revenues, you have consistent expenses, but things are going really well. You decide that you want to target a cash reserve of $75,000, which is 3 months worth of expenses, but you have $200,000 of cash in the account. Well, if you have extra cash in the business that's just sitting there, that should come out of the business account. You should use that cash effectively. And in your household emergency fund, if you're targeting, we use the example of $120,000, well, that means that if you have $150,000 in the account, you've got $30,000 more than you need. And realistically, that cash should be used more effectively than just sitting and checking your savings. Either you should fund retirement accounts, you should invest it, or maybe pay down debts. Any one of those things is effective. If you're getting 4.5% in interest in your savings account and you're paying 3% on your mortgage because you locked it in a couple of years ago, well, then maybe you don't want to pay off the mortgage. Maybe you just let it sit in savings for the time being. But the point is you want to use the extra cash on top of your emergency fund that might be there in an effective way. Same goes with extra cash in the business. So if you're reluctant to take it out of the business, remember your target is $75,000, you have $200,000 in there, you've got $125,000 more than you need. Well, at minimum, put it in a higher interest bearing type of account, maybe a CD in the name of the business. You don't necessarily have to take it out to be a good steward of that excess cash. What you don't want to do is lock up the $75,000 that's earmarked for working capital in some kind of long-term vehicle that you can't access. You don't want to go buy stocks with it because you're taking a lot of market risk with assets that are earmarked for stability. You probably don't want to buy a long-term CD like a 6-month CD or a 12-month CD because it constitutes 3 months worth of expenses. You might have to access it if something goes wrong. So it needs to be liquid. You should try to get a reasonable interest rate on that cash. If your business has debt, I'm jumping around a little bit here. So that's the $75,000 core working capital. It needs to be available. It needs to be liquid, and we want to get a reasonable interest rate on it. The extra $125,000 needs to either come out of your business or be reinvested back into the business, or maybe pay down debt if your business has debts, or if you have personal debts, take it out and pay off debt. There are a number of things that you can do with it. But what you don't want to have happen is if things are going well and cash is just accumulating, don't just let it sit in there doing nothing for you in perpetuity. You want to be a thoughtful steward of that cash. Because in this scenario, if you're a sole proprietor, you're paying tax on the company profits, whether it sits in that account or whether it doesn't. And we're going to get to, if you want to take the cash out of the account, how to do that in a tax efficient way in just a moment. But that's the framework to start with, okay? Now, most of us don't live in a world where we know exactly what the revenues and what the expenses are going to be. We've got generally more control over our expenses than we do our revenues. But most people have a little bit of volatility to that. It depends on a lot of factors. And realistically, the size of your working capital, of your business emergency fund, has a lot to do with your annual strategic planning. I'm hoping that everybody goes through some kind of process to map out what the forthcoming year or maybe 3 years looks like in the business, what the milestones you want to hit are, and what the expense structure is going to be along the way. If you don't do anything like that, please consider it, because it is a huge benefit to you personally and to your business and everybody involved in it in the long term. And by the way, a great book on that is called Traction by Gino Wickman. He lays out a really good framework for that kind of thing. So in this process, we do this in my office every November, like late November, early December, is we map out the next year of what we want to do, how much business we want to bring in, what we want to lay out in terms of financials and calendars and all that fun stuff. So I know that if my marketing budget is going to be X, that needs to be part of our operating expense figure, which flows through to the cash reserve we should have in the business bank accounts. And so if you're thinking about making a big hire, maybe you're going to bring on, just pulling this out of left field, a director of operations, and they're going to make $120,000 a year. Or let me take that back. Maybe they make $100,000 a year, and with payroll tax and other benefits and so forth, that's going to cost you $10,000 a month. Well, if you're planning on making that hire in July, then that should be factored into the amount of cash that you're keeping around for an emergency fund. So if your operating expenses are $25,000 a month, you're not making any other big capital investments in the business, maybe you start the year with a cash reserve of $75,000. But then in June, right before you're going to bring this person on, you raise that target by $30,000 to accommodate for their compensation, because it's $10,000 a month times 3. So you need to add $30,000 to your target reserve. Same goes for if you're buying, let's say you're going to buy a building or buy some capital equipment or something like that. Those you might have some monthly expenses related to those things, but usually they're one big upfront cost in addition. So you might need to factor that into the whole thing. And typically the way we like to think about this is, let's say you have some big fancy piece of equipment that's going to cost you $100,000 to purchase. You might want to earmark the cash going out in advance. So yes, you could finance the purchase. There's all sorts of ways to do this. But if you're going to pay cash for that, and you have $200,000 in the business account, you only need $75,000 of it for your ordinary monthly expenses, but you have this big piece of equipment that you need to buy. Well, don't take $125,000 extra that's extra out of the account. Leave another $100,000 in there. Only take out the $25,000 on top of that. Remember, you have $200,000 in there. You have $125,000 extra. If $100,000 of that $125,000 is going to go out the door for some equipment purchase, there's no reason to lock up that $100,000 in a long-term CD or pull it out of the business. You have that earmarked for something. So the only reason I mention this is it's nice and neat just to take a look at your last 3 months of operating expenses, average them out, and then multiply that number by 3 and say, yeah, we're good. There we go. It's a little bit more complex than that, because most of us live in a world where revenues can be a little bit volatile, and maybe you have expenses that aren't totally even either. So if you have any large upcoming expenses that are one time, earmark cash for that. If you have upcoming expenses that will be persistent, like a hire, then you might want to factor that in as well. So that's the framework for figuring out, do I have too much cash? Do I have not enough cash? What do I do with this cash coming in? You have to set a target for the right amount of cash in the business. That depends on your planning. It depends on your expense profile and so forth. If you have less than what you need, every extra dollar that comes in after your expenses each month gets added to the bank account. If you have more than you need, then every month, monthly can be overkill, but at least every quarter, review how much cash you need in the business, compare that to how much cash is actually in there, and distribute anything in excess of your threshold with respect to upcoming future expenses that might not show up on your P&L from the previous 3 months. So that's the framework. The next question that comes up all the time is, okay, I realize I have, and I'll just continue with our example. I realize I've got 125,000 extra in the business, but I don't want to pay any extra tax on that. How can I pull that out? Should I find some piece of equipment to buy and reinvest it back into the business so I don't have to pay tax? The answer is it depends mostly on your entity structure. So there are all sorts of ways that you can organize your business. You have sole proprietorships, and that means that if you have a business and you've not done anything formal, you've not created an LLC, you've not created a corporation or anything like that, you're the only owner, then the business activities are innately linked to your individual tax profile. And that means that you and the business are one in the same. The business comes from your activities. There's no asset protection. There's no separation. And it also means that if you have $100,000 of revenue and $50,000 of expenses, those things get reported on Schedule C on your own individual tax return. And that $50,000 of extra of profit is subject to the self-employment tax. You don't pay yourself a W-2 wage. It means that $50,000 left over, you pay the self-employment tax on. Now, you also have a partnership. You can create an operating agreement for a partnership that dictates what does and doesn't happen and how you resolve conflicts and what you do with the cash and all that. And your local lawyer would be the person to help you draw that up. A partnership, it does file its own tax return, but it's just like a sole proprietorship, and that the partners have legal responsibility. Everything shows up on your Schedule C. The partnership files, I say Schedule C, it's actually Schedule E, because if you own the business, let's say that, same example, but let's double the numbers. So you own a business 50-50 with somebody else. You have $200,000 of revenue and $100,000 of expenses. Well, since it's a partnership, you file a partnership tax return. And you report the $200 of revenue and the $100 of expenses. The $100,000 left over is split evenly between the partners. But the business doesn't pay tax on the $100,000 left over. It's a pass-through entity. The owners pay tax on that. So on the partnership's tax return, the $100,000 left over is split 50-50 based on ownership and is passed back to the individual owners on what's called Form K-1. So in example one, you're a sole proprietor, you don't have any partners. Everything is reported on your Schedule C. It's a pass-through entity. A partnership is also a pass-through entity. The difference is everything's reported on the partnership tax return, and whatever those profits are every year, you, the individual, pay tax on your individual return on what's called Schedule E. That's not the only type of pass-through entity. You also have LLCs, either single member. If they're single member, they show up on your Schedule C. If they're multi-member, then they file their own return just like a partnership does, and then passes the profits back to you on Form K-1. In all those scenarios, the money that you're making out of the business is subject to self-employment taxes. And what I'm getting at here is, let's go back to the simplest example. You have a sole proprietorship, $100,000 in revenue, $50,000 in expenses. The $50,000 left over, you pay self-employment taxes on, you pay income tax on. If that $50,000 is sitting in the business's bank account, and I'm assuming that you have your own personal bank accounts and a bank account in the name of the business, the $50,000 is sitting in there. You're trying to decide, what do I do with this $50,000? Do I take it out? Do I leave it in? Well, we apply the framework that we just talked about. You figure out what your target cash reserve is for the business. If $50,000 is greater than that target reserve, then you take out the difference. But since you pay tax on all the profits that come out of the business, by virtue of it being a pass-through entity, the $50,000 that's sitting in the business account, you're paying tax on whether it sits there or whether it comes back into your personal account. It makes no difference from a tax perspective which account it's in. And therefore, you shouldn't feel like you're you don't want to pull money out of the business to put in your personal accounts because you don't want to pay additional tax, there is no additional tax. You've already paid tax on that, on the profit that made its way into the account. Same goes for all those other types of structures. Partnerships, same deal. LLCs, same deal. S corporations, little bit different animal, but same deal. It's also a pass-through entity. The difference with an S corporation is that, or an LLC that files taxes as an S corporation, is that you have $100,000 of profits, you have $50,000 left over. If you're, and I'm assuming you're the only owner here, that $50,000 is not subject to self-employment taxes because the corporation needs to pay you a salary for your efforts in the business. So you've got $50,000 left over, maybe 30,000 of it you need to pay yourself in W-2 wages. And that 30,000 is subject to payroll tax and Social Security and FICA as that you pay as the employee, which if you add together is exactly the same, not coincidentally, as the self-employment tax you'd pay as a sole proprietor. So in that example, $100,000 of revenue, $50,000 of expenses, you add $30,000 of expenses to that because that's what you pay yourself in W-2 wages. You have $20,000 profit left over. That $20,000 of profit, it's a corporation, so it files its own tax return. The $20,000 of profit comes back to you on what's called Form K-1, and you pay tax on that as a business profit, not subject to the self-employment tax. So there's a little bit of, I hesitate to call it arbitrage, but optimization available related to how much you're paying yourself in wages versus taking out as profits. We've talked about that on the show in the past. But the $20,000 that's left over, it doesn't matter whether it sits in the account or whether you pull it out and put it in your personal account. You, the individual, are still going to be responsible for the tax ramifications of that. By paying yourself $30,000 in W-2 comp, that $30,000 is going to be taxed in the exact same way as self-employment taxes. The business pays half of it. You, as the recipient of that W-2 compensation, that $30,000 in W-2 compensation, pays the other half. The $20,000 left over circumvents that payroll tax, which is nice. At the same time, it does not contribute anything toward your Social Security benefits. But for a lot of people out there, that's not quite as important, and it is a nice way to suppress what you're paying toward Social Security tax. Now, you can't take everything out as profits. The IRS doesn't allow you to do that. You have to pay yourself a reasonable salary for your efforts in the business based on your industry and your role and contributions and all that. But there is a little bit of optimization available. Now, the opposite of this, so everything that we've described so far, sole proprietors, partnerships, LLCs, S corporations, they're all pass-through entities. So it doesn't matter whether the cash sits in the bank account or whether you take it out and put it in your personal account. Now let's talk about C corporations. C corporations are different animals. They're typically larger businesses. S corporations are limited to 100 owners, I believe. C corporations don't have that limit. All your publicly traded corporations are C corporations as opposed to S corporations. The C corporation pays tax at the entity level at the prevailing corporate tax rates, which are relatively favorable right now. So if you have 200,000 of revenue, you have 100,000 of expenses, you have 100 grand left over. The corporation pays tax on that. If you take the cash out, it's taxed at as the individual level too, because it's considered a dividend. So you get taxed twice. If you own a C corporation, the cash that's left over in the business bank account that you want to take out, if you want to take it out, if you take it out as a distribution, it's taxed twice, at the corporate level and at the individual level. And so whereas in a pass-through business, it doesn't really matter. If you have cash that's accumulating in there above your target cash threshold, just take it out. It's no big deal. In a C corporation, we want to measure twice and cut once, because everything you take out of there is going to be taxed twice on the profits that make their way into the account. And then again, you as the individual will pay tax on the receipt of that dividend. So what you often want to do is don't take it out as a distribution, just pay yourself a W-2 bonus. And so the benefit there is if you have $100,000 left over, you have two partners, each of them are entitled to $50,000. Well, you give both the partners a $50,000 bonus. And that $50,000, again, yes, it's subject to payroll taxes, which is the business's contributions towards Social Security and Medicare, 7.65%. And you as the recipient of the $50,000 pays Social Security and FICA and FUTA, which is also 7.65%. But that level of taxation is less than what you would pay by receiving a dividend. So this is where we want to measure twice and cut once, is in a C corporation, where if the money comes out, there is an extra level of taxation. But in the pass-through entity, which is the world that most of our clients live in, it truly doesn't matter whether it's in the business's account or your personal account. So that's the framework. We want to be cognizant of this. I don't think that most small businesses need to reset their target cash threshold every single month, but I would look at it at least once a quarter. Do the work, set a target, and then that just lets you know with each extra dollar that comes into the business, what am I going to do with it? That's your business financial plan right there. Am I going to let it accumulate because I'm shy of my target? Am I going to take it out at the end of the quarter because I'm north of my target? Or am I going to let it accumulate because I have upcoming expenses and I want to make sure I have cash set aside for that? And it doesn't have to be equipment. Obviously, it could be your, retirement plan, 401k, pension contribution, anything that shows up as an expense on the P&L that requires cash. We want to factor into this whole grand equation. And again, it just comes down to your annual business planning. So on a quarterly basis, at least, take a look at that. And then on top of that, if you have a pass-through business, don't worry about paying any extra tax on the distribution. It doesn't matter. If you have a C corporation, you want to be thoughtful about how it comes out if that's the case. For C corporations, what most operators will do is wait until the end of the year when they're doing their end of year tax planning with their accountant and financial people, and then make a cognizant decision of whether to keep it in the business or take it out. Your C corporations are those that have ordinarily they're larger businesses. They have bigger capital expenditures and budgets and so forth. So it's more frequent that you want to leave the cash in the C corporation to fund future operations, but also to avoid the tax on the distribution. Okay, I think we covered it. I hope this was in sufficient detail for everybody. It's a question that we just get over and over and over again. And like I say, I could have sworn that we've talked about this to death on the podcast over the last 12 or 18 months, but looking through the history, I don't know that that's the case. So if you've heard this before, I apologize, but it's something that is important enough for us to repeat on the show. All right, that's it for today. Talk to you all again soon.
Thanks for tuning in to Grow Money Business, the podcast dedicated to helping business owners optimize income, pay less in tax, and invest prudently. Be sure to subscribe to the podcast on iTunes, Google, Spotify, or wherever you digest podcasts to ensure you don't miss out on future episodes and announcements. And feel free to submit questions to growmoneybusiness.com.